All right, Ross. I mean, kind of an interesting week this week. We talked about the seasonality of October. We've also had the market moving on Powell comments. We've had geopolitical tensions. Now we're kind of back focused to the Fed, looking at the job market. In your mind, initial jobless claims, is that a potential market mover, or is the real market mover tomorrow, the monthly jobs report?
I think the real one is tomorrow. That non-farm payrolls report has been the biggest kind of macro catalyst for the last several months because of the implications for the Fed. It was probably the thing that sparked the Fed pivot in the first place, pushed them towards that jumbo size cut. So, claims are a great high frequency, high quality data set, but I think it's non-farm payrolls that investors need to be watching tomorrow.
So any implications to today's report? Remember, initial jobless claims, they also come out before the bell today at about 8:30 before the opening bell here on the East Coast. Any implications in your mind? Bond market, equities, anything?
I mean, yeah, absolutely. If there's an upside surprise, that's going to move markets. Again, anything on the labor market that indicates a weakness past what the Fed wants is going to have implications that trickle down into the bond market and therefore into equities. So it's something we watch closely. It's been pretty staid for several weeks now, and it hasn't indicated that it's really spiking. But you could get an upside surprise that would have a big impact on markets because, again, it's the labor market and then everything else that's driving equities these days.
All right, so labor markets seems like it's number one on your list. I want to get back to the equity market for just a second. You're looking at the S&P equal weight hitting a record this week. You also say you like large cap over small cap. A lot of people like those small caps. I'm just looking. Since the rate cut, small caps are actually down just about 0.5%. When we're talking about large caps and we're looking at the equal weight, is there a particular sector you like? Is there something that you're seeing there in particular that you like? And just for the audience out there, the S&P equal weight, that's all stocks weighted equally as opposed to the regular S&P that's market cap weighted.
Yeah, that's right. It's really an indicator of breadth of the average stock. We like to see that breadth is expanding. It was such a concern earlier in the year and in 2023 how concentrated the market had gotten. That's still somewhat of an issue, but we like to see the breadth expanding. As far as large over small, I understand the impetus to lean into small with these rate cuts. They're much more highly levered. They're linked to the domestic economy more so than large cap. But I do think that higher for longer interest rates are still a thing. The Fed still wants to get to neutral and not much lower than that. And that's a weight on small caps. So in large, the place that the large caps are overweight, things like tech, discretionary, I still tend to like those growthier and more cyclical areas of the market. I think we're on pace for a soft landing. I think large cap cyclicals benefit from that.
All right, so if we're on pace for that soft landing a lot of people are calling for, I want to hit you with the movements of utilities and housing since the rate cut. I thought this was pretty interesting. So utilities up over 3.5%. The real estate sector, actually, not housing, but the real estate sector down more than 1%. What do you make of that? I mean, shouldn't real estate be doing better with the anticipation of a rate cutting cycle?
Yeah, you would think so. And if that persists, that would be something that kind of flags on our radar as concerning. The outperformance from utilities doesn't necessarily, strike me as some shift to defensive because investors are battening down the hatches. The yield proxies, even in the defensive sector, have benefited from this rate cut. But yeah, if the Fed rate cuts and the promise of more don't spark, both market activity in those cyclical sectors, but also in the economy, right? We need to see mortgage applications tick up, housing starts tick up. I mean, the promise of Fed rate cuts has to lead to improvement in those cyclical and rate sensitive sectors like manufacturing and housing. And we'll want to see it in the stocks as well.
Do you like utilities going forward? Though a lot of people think utilities have more room to run. Do you like them?
I'm just not overly inclined to get too defensive here. We still think that the soft landing is a base case. I think there's a lot to like in 2025. And so while I understand the impetus for utilities, and I've heard the argument as the new AI growth play because of all the power demand, I still don't want to get too defensive. And to me, utilities are still best used as a defensive corner of the market. So I'm still leaning cyclicals. I'm still leaning tech and growth. But I understand the impetus. It's just not somewhere that we're going to overweight at this point.